anyway, this is going to be a webinar on pairs trading. One thing I say at the beginning of all of these webinars is make sure that you guys watch this over again relatively soon, because therefore you are going to be able to remember it a lot longer. If you wait a month down the road, it's going to be like learning this all over again. So I see there's a lot of people in here that are return clients or students of mine, and what we're doing here is we're going to be taking a lot of different strategies, kind of using my rules around those and throwing them all together. So if you're new to options trading, then please reach out and say something about your question, because if you're having a question, somebody else would. Yes, Trevor, I'm not going to repeat that, but yes, funny. Anyway, let me go over a couple of things real quick. My name is Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. I actually started trading in college with some money that I earned in high school and decided to switch my degree over to finance after about a year. And after graduating college with a finance degree, moved to Chicago and started working on the floor of the Board of Trade as a clerk, actually, and then took that money that I had been trading with and building up and bought a badge, jumped in the pit, and started trading. So in that time, I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all of these products in all market conditions. So in the 25 plus years, I've seen a lot of different crazy trading going on. You can follow me on Twitter at Wolfman's blog, or you can follow Pro Trader Strategies at Pro Trader Strat. Pro Trader Strategies throws out a lot of market wisdom, and hopefully I do as well, but you'll get the snark along with it, so, if you're following me. I got this disclaimer to go over real quick. Any opinions, news, research, and analysis, or other information contained here, material provided by Pro Trader Strategies and associated companies, employees, is for general commentary and does not constitute investment advice or solicitation to buy or sell any of these securities or strategies. A couple of things to disclose. We may be talking about some stocks that I have. I'm not trying to get you guys to living off the cliff. At the end of the day, trading is also very risky, and you could lose substantial amounts of money. But you guys probably, a lot of you may know that, but I have to mention that anyway. And please remember that past performance of any trading system or methodology is not necessarily indicative of future results. All right, so pairs trading. What we're looking for with pairs trading, a lot of people talk about pairs trading where you're just kind of like buying two stocks and, you know, looking for them to kind of both go up, or if one goes up and the other one goes down, you're still kind of hedged in a sense. What I'm looking for with a pairs trade is I look for correlated underlyings that have a divergence, and a divergence is basically they've kind of separated that. All of a sudden now they're not necessarily moving lockstep or in tandem in a sense, and we're going to figure out how we can figure out the correlations and stuff like that. I've got a really cool website that I can show you guys, and I'll mention it here in a minute, but we're looking for where they have all of a sudden kind of split their ways for a little while. And the assumption is that they may have separated for a short term, but they should come back into line with one another. So that's the kind of thing we're looking for to start trading these. And I've actually done another webinar on pairs trades and have different strategies that I have set up for that. So if you want to check that out also, I'm not going to go over those other strategies, but I've been looking at another strategy that I'm really starting to like, so I wanted to bring that out in this webinar so that it can kind of go along with that other series of webinars on pairs trades. So like I mentioned, we're looking for highly correlated stocks that have a divergence. One thing we can do to find these highly correlated stocks is to go to this website, and it's actually really pretty cool. So you guys can write this down, which is this same website here. And the neat thing about this is, you know, it kind of dumbs it down. You can do it on charts and stuff like that, find the correlations. What I usually do is cross-correlate it with this and start out here. So you can also do pairs trades with negatively correlated, like Apple and IBM are very negatively correlated. So in a sense, if they started trading together, you could trade it, you know, as a contrarian that they're going to separate again. I'm not going to really go into that necessarily right now. I like to look at the ones that have a tendency to run lockstep. But the nice thing about this website is, you know, you would think that like Ford and GM and you know, like the Qs and the SPY or Home Depot and Lowe's would have a high correlation, which they do. But the nice thing about setting it up with this table is that you can find highly correlated stocks that you wouldn't necessarily think are highly correlated. So in that, you know, we can look at IBM or Apple and see who they are correlated that you wouldn't really think. So in this, you know, American Airlines is highly correlated, very highly correlated to IBM, which is a bit odd, you know. I mean, I could see American Airlines being correlated to Delta or UAL, those kind of stocks, but the fact that it's that highly correlated to IBM is kind of interesting. You can also see that IBM is really correlated, highly correlated to CVS. So, I mean, who knew that IBM would be correlated to a drugstore, if you will. So anything over 70 is a strong correlation. It's 60 is significant, they say, but I like to look at the ones that are over 70, and even especially if you can find a 90 plus, that's great. So that's pretty cool about this. So you guys should all write down, you know, the website for this. That's the only thing I really use this website for. And if you don't have to have a membership or pay for the services. You get a couple of chances to reconfigure this per day in a sense. So you can pull all these out and put in some stocks that you like to trade. But that's a really cool one. So you basically kind of start from there and then start looking at the charts to kind of figure out where you're going to go after that. All right, to find the ones that are separated. That's not going to tell you what the ones that are separated, it just tells you the ones that are really highly correlated, which is very helpful. Link for the correlation studies. It's in that URL there. This is it right here also. And then, you know, just kind of jot it down real quick. The other one is, it's the same. It's just that link right there. macroaccess.com/invest/market correlation. Do you ever do trades with underlyings that might be correlated inversely, like maybe airlines to oil stocks? Actually, believe it or not, airline to oil stocks are pretty correlated, but I don't really do it a lot unless I've seen them kind of start trading real close to each other. Then yeah, I will play those to kind of separate and go opposite ways. Or if I start seeing a sector rotation, which is usually what I think what you're talking about. So if I start seeing a sector rotation happening where maybe people are pulling out of healthcare and into tech, then that's where I'm going to kind of try and play that kind of situation. Do I ever use Impacopedia for correlations? I haven't, Rudy. Usually just go to this one, and it's just none other than that. I haven't heard of the one that you're speaking of, and two, I've just been using it for a while, so I just go back to that one. What do you do with the correlations? Great question. We're going to get into that, Jim. I'm just trying to set you guys up for all of this. So we kind of start out there, find the ones that are highly correlated, and then when I pull up the platform, you'll see that in a minute. Do they trade options, have volume, and good bid-ask spread? Yes, they will. All of those that were on that little chart there that I have always have that. So that's something A great question. You know, Trevor's been in a couple of these different webinars. When we're setting up these option strategies, one thing to keep in mind is always trade options with a tight bid-ask. That being said, a tight bid-ask would be something inside of 10 cents for a stock that's $100 or less, and then if it gets over $100, it's kind of difficult to find a lot of stocks that have that tight bid-ask. But in that, what I look at is moving the decimal 3 ticks to the left, and that's how wide those spreads should be. So on a $150 stock, when you go into the option montage, you know, so anywhere less than 45 days or 50 days, that bid-ask that's close to at the money or just out of the money should have that tight bid-ask, and that'll give you the indication that there's a lot of volume and open interest. Waste management's one where it's kind of teetering on having a lot of tight bid-ask, but sometimes waste management, even though everybody's heard of it, there's just not a lot of participation in those options. So that bid-ask could be like 25 cents wide for a $70 stock. So that's just too much edge to give up to get in and too much edge to give up to get out. So kind of stay away from those, and keep that in mind. Any option strategy you're ever trading should have tight bid-ask and a lot of volume and open interest. Especially when it starts getting busy, people will leave that option and be trading the ones that are more liquid. It's another indication of liquidity, is when there's a wide bid-ask, there's not very much liquidity. So anytime there's risk, there's got to be reward, and if there's not a lot of liquidity, there's more risk for the counterparty, and they will make those bid-ask wider. So when there's a lot of participation in there, there's a lot of fighting over who can get a better give a better market, I should say. When there's not participation, it's, you got to come to whoever's on there. Okay. No, that was not a. There's no dumb questions. So what's the max bid you might recommend? Max bid ask you might recommend. So on a $100 stock or less, my rule of thumb is a $100 stock or less. It's got to be inside of 10 cents or 10 cents or tighter. That means, like, if it's $1, the offer should be $1.10 or less. And then, you know, if it's a $300 stock, if we move that decimal points 3 ticks to the left on a $300 stock, the bid-ask should be 30 cents. $1,500 stock, the bid-ask differential should be about $1.50, because we move that $1,500 stock, take the decimal 3 ticks to the left, that's about $1.50. So that's kind of like the rule of thumb for that. So there's not really a max that I look for. It's going to be dependent, because the higher price stocks are always going to have wider bid-ask. Even though, like, Priceline or something like that has a lot of participation in there, there's still going to be a little bit wider bid-ask on those. All right? All right, so then strike location. With this, we're kind of be, for the defined risk strategies, we're going to be looking at around the 35 delta, and that's going to be both. The way I've set this up, I'm going to pick an environment where one of my stocks actually has high implied volatility, so I'm going to try and take advantage of implied volatility coming down, and then on some of the other ones, or on the other side, the other pair side, it's going to have low implied volatility, so I'm going to try and take advantage of implied volatility expanding, and hopefully, you know, if the one that we have the short strategy has implied volatility expand on us, and that would hurt, hopefully the one that we are long, the spread will increase in volatility as well, causing us to kind of offset in a sense. It's not a perfect world with this strategy, and there's a lot of moving parts with this. So it's not like we could actually have both our break-evens tested, whereas like an iron condor, you know, the market goes up one way, you know that if the market goes up, you know that put spread in that embedded in that iron condor can't get tested as the upper band's getting tested. The market can't move in both directions on any one underlying, but we're going to be using two different underlyings, so there's a little bit more risk to that. So given that there's more risk with this one, this is one of those ones I want you guys really trading small in percentage terms to your overall portfolio. So should not equate to more than like 2%. You know, I usually say with most strategies or any underlying, you know, 5% to 10% is kind of where you want to be with those. This one is going to be super small. It's more of an engagement type of trade as well. You know, it's a higher risk strategy just because both could actually lose money. But in that, you know, it's going to keep us engaged. It's going to really be thought-provoking and make you better traders, actually. And it's actually a pretty cool setup. It's got good hedging properties to it. So, all right, and then picking the right environment. Like I mentioned this earlier already, with this particular strategy, the way I'm going to set it up, we are going to be looking to have one of the underlyings have high implied volatility and its correlated counterpart have low implied volatility, so we can kind of try to take advantage of that. Do I have option alert services, daily, weekly, monthly? I actually have a daily market commentary where I will go out and tell you exactly what trades I'm putting on, when I'm taking them off, when I am getting tested on those, and if I'm getting tested on those, how I'm being mechanical and trying to turn a loser, in a sense, into a winner. So I go through all the good, the bad, and the ugly. I tell you about my winners and I tell you about my losers, and I actually probably talk about my losers more than I talk about my winners, because I think it's really important to stay mechanical and you know, be diligent in defending those strategies that are going awry. So watch those. I don't think enough people take advantage of those. So watch those daily market commentaries, because I go through all of it. And I don't give alerts like, hey, you know, this is a great strategy, or this is a great underlying, this is a buy, buy, buy. You know, I'm not that guy, because I'm here to teach you guys how to swim. I'm not here to swim for you. The other thing is it's not responsible for me to tell you that you need to go out and buy a certain stock, because it might exceed your risk parameters. It might be counterintuitive to what you already have in your portfolio. So it just isn't right. And that's all I can tell you is it's not right when people say, hey, you need to go out and put this in your portfolio, because they don't know. They don't know you. They don't know what's in your portfolio. So I hope I answered your question there. So when you go to the website, do you type in the name of the stock to find other correlated stocks? Yeah, you can click out of a few of them and add a few, or you can click out all of them and add your own and build it out. It'll build it out for you. If an attendee has missed any portion of this webinar, will they be able to replay this webinar? Yeah, we're going to be sending this out, Mills. So this is being recorded and we send it out. And one thing, even if you watch the whole thing, watch it over again, because it will help keep it in mind. So like I said, we're going to be trying to take advantage of some of that theta decay as well. With the way I try and set this up, many of you guys that watch a lot of my webinars know that I don't like to pay for a strategy. Now, I mentioned that I'm going to be selling one strategy and buying one strategy. I'm going to try and build this out where I'm actually getting a credit for this. So I'll show you some different ways to do that. But not always, but I make it a concerted effort to get a credit when I'm doing these strategies. All right. And position size, I mentioned this already. Position shot size should be less than like 2% of your portfolio value. Just make this a very small investment. It keeps you active. It will keep you, learning, because there's a lot that goes into this, and there's a lot that could go wrong. So don't bet the house on any one strategy, let alone this one. All right, so keep it small. A lot of new people. There are a lot of new people in here today. Yeah, we got a lot of people in here today. So all right, the exit strategy for this trade. So because a lot can go wrong with this, we want to kind of look at it like we're going to try and get in and out of this strategy about as quickly as possible. You know, perfect world, we're going to get 30 to 50% of our max profit. I'm never going to ride this thing, or any strategy, if you guys have been around for a while, into the sunset and try and collect every last penny. That's, if you're beating the probabilities, get out. It's you know, don't just keep throwing probabilities out the window. If you're beating the probabilities, that's the time to get out. And it's a kick in the pants when you beat the probabilities and you just kind of watch it turn around and the probabilities end up beating you. Because anytime you can beat the probabilities, it's a winning trade, and the probabilities usually are going to be against you in most option strategies. So that's why you got to get out early. Days in the trade. So basically, if we're in this trade for 5 days and I can get about a 15% of my max profit on it, I'm going to get out. You know, 10 days in the trade, 25. These are ballparks. You know, you can kind of play around with it. But anything less than that, if I'm in it for 10 days and all of a sudden I'm getting a 35% of my max profit, I'm out. I'm out the door. So keep that in mind. So anything less days and you're getting that max profit, then go for it. Get out. All right, so let's pull up the platform here. Oh, so here, this is what I usually, let me pull up this, one. This is the chart I use. So somebody mentioned, you know, how do we find those correlate? Well, we go to that website, figure out what has high correlation, and you can kind of punch it in. Some of those were like IBM, I think it was, what was it, IBM and, so IBM, I'll just put it in here, IBM. All right, so now this is IBM, and if you can look under here, this is XLK, all right? Well, we don't want XLK, we want AAL. So go into the studies, and you get rid of basically everything I left in the histogram, implied volatility, but go over here and just type in comparison, and it'll pull it up, and it's going to give you the default of the SPY right here in that line. But all you have to do is click on this little gear, go in here, and you can change it around to whatever you want. So in that example, it was AAL. I probably should have put IBM in here, but because I wanted to show the correlation with, what was it, CVS. Actually, I will. I'll do that so we can see a couple of different ones. So I'm going to go IBM in here, and IBM's not going to change unless you go in there and do that. And sure enough, IBM and IBM are highly correlated. AAL. So you can see they are pretty correlated. Now this would have been a situation where you start seeing IBM going down and, IBM going up and American Airlines going down. That would have been a time to kind of take advantage of it. Yeah, it would have hurt for a little bit, but then you can see they will want to come back in line, and they are separated a little bit. It looks like American Airlines wants to go up and IBM wants to go down in this situation, but I don't know that that's at enough of an extreme to really jump on that. The other thing with these two is they both have low implied volatility, so that doesn't really work with the strategy that I wanted to look at. But you know, and again, we can look at CVS. I think it was CVS and IBM somehow are correlated. Now you can see there's a separation here, but the idea is this is going up and this is going up, right? And then you want to catch it when one is going up and the other one's going down, and that's where that's the divergence, kind of like here where this one's going American Airlines, or sorry, CVS is going up, and CVS is going down, and IBM is going up. So those are the kind of situations you want to look at. Now, I don't often like to look at, hindsight being 20/20. Yeah, of course I should have done that, but you can see that on the chart, it goes down here, it goes down here. You want to look for it when, not when they're just on top of each other, but when they stop moving in the same direction for a brief period of time, because they will have a tendency to catch up. Kind of like here, where it's kind of going down before the other one started catching up, and in that situation. So this is the chart right there. Like I said, I'm going to be playing around with this one for the most part until we can find something that has good implied volatility. So, but to find good implied volatility, what I want to do is go over here to the side. So this is my watch list, and I put in implied volatility % over here on the side, and I'm looking for something with high implied volatility. Is still high implied volatility. Above 50% is my rule for that. But if we have an ETF, where is this tool located? Are you talking about the implied volatility % or the chart? If you're talking about the chart here, basically this is just a regular chart on Thinkorswim, and what I did was get rid of everything. So I can show you on a different one actually. I could just pull up, let's say I pull up this one, and I have all this stuff on here. Basically I just go up in the gearbox and I just get rid of everything. I exit out, and it gives me a clean chart. Alright, so then it would get rid of all this other stuff. And then I go in here and I change whatever's in here. So you go over to the, sorry, I want to go over to this, no, I want to go to the chart. So how did I do this? Drawing, no. So you want to change the chart to a, there you go, chart from candlesticks to a line. Okay, so go to the, or whatever you have as a bar, and it changed to a line. Then the next step is to go into the beaker and then type in comparison line, and it's going to default at SPY. Just click on the gear again, and you can change the secondary security. You can change the color and all that stuff too, but that's how to get this chart. And then same thing with the implied volatility %. You just go over to the gearbox and do customize, and then type in implied IMP volatility. Just type in IMP and you'll see it come up. Implied volatility %. So we're looking for a stock that has above 50. That may have been in that list. Well, there's really not a whole lot to look at. But one thing also to note is any ETF or index that has implied volatility % above 30 fits also, because remember, it's a basket of underlying. So if it has a implied volatility % above 30, that's pretty good. That means a lot of those stocks have pretty decent implied volatility within there. So we want to look for something that has, did all of mine just fall out? Oh, it did fall below it. So XLK was one that I was looking at earlier, and I was also looking at XRT. I don't see XRT on here anymore. It must have come off a little bit, unless I accidentally got rid of it. But we'll look at both of them. So let's just look at XRT. And the other thing is you're going to need to know what's in these ETFs. XRT is the retail, and then XLK is the technology sector. So let's start out with the XLK, because I know a lot of you guys like tech, so we'll do that. And we can start looking at correlations with the tech sector. Yeah, it is below 30. It was just above 30 right before the close. It just must have come out a little bit. So we want to go up to that chart again and look at the XLK. So actually I'm going to make XLK the default. So let's put in XLK here. XLK, so I don't have to go back in here every time. Apply OK. And then I'm going to go in here, and so in like XLK, it's basically any technology stock. So if we don't have this tool, this is Thinkorswim. You might actually have this tool, a comparison thing. I don't know, but the best thing to do would be to call them up and ask them. But a lot of times you can overlay two stocks on one chart. There is almost always a way to do it. I mean, every platform I've ever traded has had a way to do it. Sometimes there are different steps, but so Apple is highly weighted in this particular ETF. So in that, it really is one of the things that's driving this market for the most part. If you ever saw a divergence with this particular ETF and Apple, that would be a definite time to jump on it. So, you know, kind of like you can always see when Apple's going up, it's going up, but it's highly weighted in here. XRT is nice because, which is the retail ETF. Nice thing about it is it has pretty equal weighting of, you know, between like Walmart, Netflix, and like Costco, things like that. So, but this one gets a little bit wanky with that. So then we want to go in, let's check out Microsoft because it's in here. Pretty close in correlation. We can look at Visa's in here. Why it's in a technology, I don't know. IBM has good separation. You can see they're going up and IBM's going down. So that's a pretty good separation. That's what I'm talking about for, you know, you're getting the divergence going on. So this might be a good time to look into this. What we're going to do now is go into the trade window and we're going to look at XLK. We've got very close to a 30, close enough for government work. So then we're going to go into the 30, you know, somewhere inside of 45 days. So same instance with almost any of my other strategies. It has gotten a little wide on this right here. This one says 12 cents, but I can assure you that it is generally inside of 10 cents for the most part. There's a lot of people in here, but it being a Friday, it's gotten a little, Friday after the close, people pull their orders. So you can see volume and open interest. There's good open interest, good volume, and basically all the strikes, so it fits the parameters as far as I'm concerned. So now remember, what is our thought process here? We have to go over that, I guess. My thought process is IBM has got to catch up with XLK, or XLK's got to catch up with IBM, right? So that's our thought process. These have got to converge again, or at least get tighter. One's winning, one's not, and no telling why. So our thought process would then be, let's short the XLK and get long the IBM. Now this is where I was talking about both of these could go wrong because XLK could go up and IBM could continue to go down. But IBM's in here, so IBM should pull it down with it in a sense. How wide of a separation? I'm just looking for them to start to go in opposite directions. As soon as they start, which they are, this is, you know, the start of the opposite direction. But just like here, when they were kind of going in opposite directions here, they had to get tighter. They had to, one's got to win, right? They got to come back into line with each other, and this is getting wider, kind of like Bollinger Bands when they get wider, right? That's when you're looking to implement something like this. So I want to short deltas XLK, so I'm going to be looking at around the 36 delta for this because we're going to be putting this on as a spread. And I want to try and get a dollar-wide strategy, so I'm going to sell the 36 delta and buy this one here. So it's anything on a dollar wide, I'm going to collect about a third the width of that strategy. So 28 cents is good. 33 cents is great. The least I'm going to accept is 25 cents. So then the next one we're going to look at, so then you have to make sure that with Thinkorswim or however your platform is configured, you have it on blast all, so that you can combine these two in a sense. So then we're going to go to IBM, or wait, what was it that we were, IBM. So IBM, we want to get long it. So I'm actually going to be looking at a call spread here, and it's going to be about the same kind of situation where it's actually going to be a little bit tough to do because they're $2.50 wide. So that's going to throw off my strategy a little bit. But let's just see what happens. I may have to make the, it's not going to work. I'm going to have to buy this one and then sell the $2.50 one, and we're going to be paying a debit for it. So that doesn't work. So, which is why I didn't have it marked down on my thing. So let's look at another one. So we can go on to one that I vetted to make everybody's life easier. So Verizon is one. So again, Verizon is also separating, from these, and Verizon almost even looks like it's more correlated than even IBM. Again, here was a situation where Verizon was going down, Verizon was going up, and XLK was going down. So that's the divergence we're looking for, and sure enough, look, they kind of came back in line. So obviously, we want them to come back in again. So XLK outpacing to the upside, Verizon lagging to the downside. This makes this a lot more palatable, I guess, or easy to set up when, if you look on this side, this is the Verizon pricing, and then this side is the comparison pricing, which is the XLK. So let's look at, if I can get rid of, can I delete that one? Oops. So I want to go to Verizon. It's actually, I'm going to have to go back to XLK to get that back up. So again, we were looking at the 37, 36 delta. The reason why we're doing that, it's like one standard deviation. That makes it usually the easiest way to get your 30-some cents for it. Oh, delete that one. Why do you keep popping up? Is there any way to get out my, I don't want that to go away. Oh, here, that's what I'm doing wrong. Yeah. All right. So we got our 28 cents. We've got it on blast all, so we can build this out. XLK, and we were looking at Verizon. So we think Verizon is going to go up, so we're going to be looking at a call spread in here, and kind of the same situation where we're going to be looking at about $1 wide and try and pay less than 28 cents for it if it's possible. So $1 wide, and we're paying 19 cents for it, which is good. We got $1 wide one. We're still at about that 30 delta. We could probably even go a little bit tighter, increase our chances of this working out. So I'll change this to the 50. Change this to the 51 and see what we got. 32 cents. This brings up a great question. I like to get a credit, but do I want the penny or do I want the trade? And at this point, I kind of want the trade. And for 6 cents debit, I think it's kind of worth it, because this is a high probability trade. Buying the 50 calls and selling the 51 calls. That's a high probability trade. So, and we're only paying, in a sense, 6 cents for it, right? Because, or now we're only paying 3 cents for it. So that's a high probability trade. You're right at the money with these 50s. I mean, any movement up, for the most part, we're going to be making money. So I would probably be willing to pay, you know, those 3 cents to be out at the money on this call spread. So I'm going to be willing to do that. And XLU, I like that separation. So this is probably the trade that I would put on after going through all of those steps. You know, it did take me a while to go through and do all these different correlation studies to come up with this. It is a little bit more work. And of course, you know, make sure you adjust your parameters to making it like, you know, if you're used to trading 5 lots, make this a 1 lot for sure. You know, if you're doing 1 lots, you might think twice about doing this, but just keep in mind to cover it early as soon as you start seeing a profit. Does that make sense? How risky is this strategy? Luke, great question. It is risky in the sense that you can lose on both of these. But it also is, you know, counterintuitive when 2 underlyings that should be correlated, right? Verizon is in the XLK, so they should be running in tandem. So keep that in mind as well. You know, anytime there's separation, the idea is that they're going to come back. But there's risk in this because we could lose on our short call spread because XLK goes up and Verizon continues to go down. It's very counterintuitive, but it is risky. But it's defined risk also, and it's appropriate, excuse me, for an IRA if you're trading in an IRA because both strategies are defined, right? So you could, in a sense, you know, lose the full 74 cents on this one, and you could lose the 32 cents here, so just a little over $1 on it. But you know your risk going into it. How far out do you go out time? I usually, you know, with this strategy, I like it to be about 45 days, somewhere inside there. So I'm right on the cusp of going, you know, out to these 50s. You know, if I was able to get it for a credit, I'd probably likely go closer in time. Might need to look at this strategy in the 56 days. We got a couple of minutes, so let's just look at it, see what it looks like, see if we can do it better. So Verizon, we were looking at, oh, but they're going to end up going in $2 wide. Let's see what if XLK, but they're in dollars, so we're going to have to almost go $5 wide in order to get that to work out. That's another thing to look at. You kind of want these spreads to be equal distance in a sense, being $1 or $2 or, you know, they're both $1 or $2 or $3. And the reason why is because we want our deltas to be relatively offsetting in a sense. We're short on this one, you know, I think we're short about, you know, 5-6 deltas. We're long a little bit more deltas with the Verizon, which makes us a little bit more bullish in a sense. So because we went a little bit closer to the money, we've got 12 deltas, so we're long 5 deltas, but that's pretty close anyway. Is this considered a high probability or a low probability strategy? At the end of the day, it's difficult to determine whether or not it's a high probability trade or a low probability trade, but or to come up with exact numbers on it. Whereas, you know, I can tell you exactly what the probabilities of success on this one are, or the probabilities of success on this are, but they're not necessarily mutually exclusive, right? So, in that, it's a high probability trade because when there's a divergence, there shouldn't be one. So it should come back into line and back into normality. Now, is that always going to happen? No, not necessarily, but the likelihood that they will come back into line is highly probable because of the correlation coefficient. So, you know, probability of, what we can do is look at that website that I said. So if the correlation coefficient on these is 96, that means they should be running in tandem 96% of the time. So if you get that 4% out of line and you can take advantage of it, that's a high probability that that's going to come back in the line. Now if you're doing it with a 45, it's a weak correlation. That's about a 50-50 chance it's going to happen. 50% of the time it's not correlated, 50% of the time it is correlated. This is saying 96% of the time these are correlated. So that's why I'm telling you you should go with a high correlation on this study. So that's a high probability that they will be in line where they're suited, right? Does that make sense? Does that answer your question? So these are the probabilities in a sense, that because this is that they run together 96% of the time. Does that make sense? Even though I don't have XLK up here or Verizon, but they are highly correlated as well. This looks like it's correlated for the past 30 days only. Which one? The one that I had up? So if you're looking at how tight they are next to each other, that doesn't really mean the same thing. Like this, see how this one's going up and this one's all going up at the same time, and then they turn around, they both start going down together. Now here they're coming in tight, but then they start separating. This one goes down and this one's going up, right? That's the separation you're looking for. And it can continue for a little while, but then you see they do come back in line, and that would have been within your time frame of one of your option series. So hopefully, anyway. I think this is on a 3-year study too. So this is a 3-year study. So they are pretty, even though they're separated here, you can see that they're both going up and down at the same time, and it's kind of easy to run this along the line just to kind of check it. But right here, you can see it's going up, and we're trending down still. So they should come back into the line. Does that make sense? Oh, the micro-axis data. Yeah, it may be for the last 30 days, but a lot of times those, when they're highly correlated, they're highly correlated. And I think you can actually change around those parameters. I don't know that I did that. May have forgotten to do that. Okay, would using TOS correlation studies script on your TOS charts improve your success with this type of strategy? Shady Tree, you've been quiet. Good to see you back. For this strategy, I wouldn't necessarily say that you have to do it, but when, it's hard to find high volatility strategies right now, and this is a good way to take advantage of the ones that do have it, and you have plenty of other ones against it. So this, to me, I always look at this when I'm ever looking at any type of correlated strategy or pairs trade, if you will, or if I'm looking to hedge something, I'll pull this strategy up to see if I can find anything that can help me out. Like, especially if I have long stock or something like that, and I'm selling calls against it because it's going down, I might look at other trades that I can put in, like some short deltas against it in some other correlated underlying. Especially if mine's going down and the other one's going up, like maybe Deere and Caterpillar, or something along those lines, or Visa and MasterCard kind of thing. If I was long Visa and Visa was going down and MasterCard was going up, or vice versa, then I would look to start. If I was long MasterCard and it was going down, I would look to kind of like at these studies with Visa and MasterCard and say, all right, well, I can short Visa here because they've separated in a sense. That makes sense? Anybody else have any other questions? This trade is convergence. Do you also do trades anticipating explosion or and divergence? Well, yeah. So you're right. I'm looking for them to converge, right? I'm looking for them to come back in line. So I don't really look at it the other way, where they're in line and looking to separate, because that's more of a crapshoot, right? We're looking for the ones that are highly correlated. I have played around with, truth be told, the ones that are uncorrelated or very uncorrelated, and try to play them against each other to, you know, go back to the normal of being separated. But I don't do that as much as I look for them when they're out of line to come back in line. All right. Anybody else have any other questions? All right, so we got a, we just came out of earnings season, but we are obviously, anytime the earnings season ends, we got an earnings season coming back in, and we built a class around earnings, and it's the first time we're releasing it. It's $36. I mean, you can do that in one trade, or you're going to spend that at happy hour tonight. But anyway, $36 is a great deal. This link to this right here, Pro Trader Strategies Option Course, is in the chat window. We've been going back and forth in the questions box. Look in the chat window there. It's easy link there. It's $36. Also, call us at 310-598-6677, or you can email us at trading@protraderstrategies.com. But this is all my favorite trades that I like to do around earnings. And if you guys watch those daily market commentaries, I love earnings season, especially because it's high implied volatility and we can take advantage of it rather easily. We're in and out of trades and don't have to mess around too much. So this is a great deal, and what you can learn from earnings trades that, Goldman Sachs came out not too long ago, and I have an article somewhere on it. The guy was telling us to go out and buy calls ahead of earnings, a week or so ahead of earnings, and then cover them the day after the earnings announcement. Now, that is the worst advice I think I've ever heard anybody give. But because of the volatility collapse that I try and take advantage of with volatility collapsing after that binary event. Anytime there's a binary event, you get volatility to explode. You sell premium on that, it gets you really far away from where the underlying is trading, high probability trades, and then cash your chips in the next day. But this guy I couldn't believe he said it. But then again, anytime those talking heads like Goldman Sachs, I used to have a customer from TMAT one time. I saw him on CNBC. I'm in the pit, and he was talking about, oh, the Fed, the Fed's got to raise interest rates, da-da-da-da-da, and, they got to do it right away. And literally in the pit, his order was to buy Fed funds, which meant that the interest rates were going to go down. And he completely was talking opposite of what his position was, just to try and get people to jump off the cliff and into his lap. But so be wary of those guys. I mean, I talk about probabilities, and this is a great little strategy here. So, or several of them. Do I prefer butterflies during earnings trades? Rudy, I actually like the condors and when I'm not directional, and call them put spreads basically, depending on my assumptions there. Do we look for non-trending stocks in the pairs, or does it make any difference? I look for, no, it doesn't make any difference, Jim, I guess is what, as long as they are just starting to separate, and it may only be for like a week or so they'll separate. and then that's when we're looking to take advantage of it. And so one could continue to go up, but we're looking for the other one to kind of outpace and kind of catch up. So maybe it'll kind of go sideways and the other one kind of flies to catch up on the side. Chris, the link is in the chat window. It should be right there. If you pull up the chat window, it should be in there. I posted it. Hopefully I did it right. So yeah, it's pulling up. So I clicked on it. It works. That did it for me. And that's the offer. There's no chat window. I got a chat window. I don't know. It's not over there on the dashboard for the chat. I can give you the link here. Here, I'll try and send it out this way, see if it works. Send to all. Oh, I guess it only went to you, Chris. Let's see if I can. That work? I have, okay, you have chat. Can you see, can you just tell me if you see that link in there at the bottom? Okay, yeah, it's there. Okay, good. All right, great. Thanks. See, I'm running the show today and clearly having a lot of snafus. I started the webinar without having the mute off and everything else. So how did he type that then? I put it in the window. I put it in there. I put the link in there myself, and I didn't know if I did it correctly or not. So, all right, that's all I got for you guys today. Have a great weekend. Thanks for joining. One other thing, I just want to thank you guys all for participating in here. Later webinars, I'm going to be drilling down on different option components, how I trade, trades I find, when and where I find them appropriate. Here is that link as well, so if you're like watching this on, the rerun or the tape, you can just pause and write it down, type it exactly like that in the URL. And thanks for watching. Again, you can call us at 310-598-6677 or email us at trading@protraderstrategies.com. How long is the earnings class? There's several videos in there, so I've done quite a few of them. I think there's at least, I don't want to say, but there's at least 5 in there on the earnings. Thanks, Rick. Thanks, Rich. Appreciate it. Thank you, guys. Thanks for all the kind words. And each one of those classes are about an hour or so. Take care, Shady Tree. All right, guys. Have a great weekend. Bye-bye. If you can't take that, take it easy.